Imagine this, it's 2026, and you're scrolling your feed when a notification pops. Your bank, yes, the same one that once laughed at Bitcoin, now offers crypto trading right in the app. Convenient, right? But here's the twist. Last month, a regular guy in Seattle lost his entire savings not to a market dip, but to a stranger who showed up at his door with a wrench, demanding his wallet seed phrase. He wasn't a whale, just an everyday investor who posted one too many wins online. Welcome to Crypto Basics in 2026, where opportunity meets a whole new level of real-world danger. Why does this matter now? Look around. Crypto isn't fringe anymore. Spot Bitcoin ETFs hit $200 billion in assets under management last year, pulling in pensions and 401ks. Governments are rolling out regulations like the EU's MITA framework and the OECD's Crypto Asset Reporting Framework, which kicked in January 1st, making exchanges report your trades straight to tax authorities. It's more accessible than ever. Your phone can hold a fortune. But with mainstream adoption comes mainstream threats. Scams evolved with AI, physical attacks are up 300% in high net worth circles, and volatility, still wild. If you're an everyday person dipping in, ignoring the basics isn't just risky, it's reckless. Let's break it down like a story. Meet Alex, a 35-year-old teacher from Chicago. Last summer, he hears about crypto from a podcast. Sounds intriguing. Digital money, no banks in the middle. So, step 1. He learns what it is. Crypto runs on blockchain, a digital ledger that's like a shared Google Doc, but tamper-proof. Every transaction gets verified by a network of computers, not a central boss. Bitcoin, the OG from 2009, is digital gold, scarce with only 21 million ever to exist. Ethereum, launched in 2015, adds smart contracts, letting you program money like apps. Alex starts small. He downloads a reputable app like Coinbase or Fidelity Crypto, platforms with insurance against hacks and proof of reserves audits, showing they actually hold your assets. Step 2. Buying in. Alex links his bank account, buys $100 of Bitcoin. It's that easy now thanks to Spot ETFs approved back in 2024. No more shady offshore exchanges unless you're chasing obscure tokens. But he doesn't stop there. He sets up a wallet. Software ones like MetaMask are fine for small amounts. Think pocket change. For serious holdings, he grabs a hardware wallet, a USB-like device from Ledger or Trezor, keeping his private keys offline. Private keys. That's the password to your crypto kingdom. Lose it, and it's gone forever. No reset button. Now the mechanics kick in. Alex wants to send some ETH to a friend. He scans a QR code, her public address, and hits send. Miners or validators, depending on the chain, confirm it, adding the transaction to the blockchain. Fees apply. Gas on Ethereum, Sats on Bitcoin. In 2026, with Layer 2 solutions like Optimism, those fees are down to pennies, not the $50 spikes of 2021. But here's where it gets interesting. Alex dives into DeFi, decentralized finance. He lends his stablecoins, like USDC, pegged to the dollar, on platforms like AV, earning 5% APY. No bank teller involved. Smart contracts handle it automatically. But peel back the curtain and the math gets uncomfortable. Crypto's volatile. Bitcoin swung 60% last year alone, up to $120,000, down to $70,000. Studies from 2025 show 75% of retail traders lose money, not from bad picks, but from timing the market wrong or getting wrecked on leverage. Fees compound it. Exchange trades nibble 0.1%, but DeFi swaps add slippage and impermanent loss if you're providing liquidity. Then there's the hidden toll, energy. Proof-of-work chains like Bitcoin guzzle electricity equivalent to small countries, though Ethereum's switch to proof-of-stake in 2022 cut its footprint 99%. And taxes? That CAF reporting means every swap is tracked. Forget anonymity, it's a myth for most users now. Contrast that with the hype. Remember 2021? NFTs exploded, Bored Apes fetching millions. Fast forward to 2026. Most are worthless, but utility ones tied to real-world assets like tokenized real estate are thriving. Memecoins? Dogecoin's still around, pumped by influencers, but they're lotteries. One X post from a celeb can spike 500%, then crash. Reality check. True value comes from utility. Bitcoin as a hedge against inflation. It's up 15,000% since 2013. Ethereum powering Web3 apps. Stablecoins moving billions in remittances for migrants, cheaper than Western Union. But the absurdity, billions lost to rug pulls, projects vanishing overnight. Or AI-generated phishing emails so convincing they mimic your exchange perfectly, tricking you into approving a drain. As stakes rise, so do risks. Physical attacks are the new nightmare. Data brokers sell your address if you've ever KYC'd on an exchange. Pros like former CIA officers now advise zero crypto at home. Split your keys across geographies with multisig setups, where you need 2 of 3 approvals to move funds. Time delays on withdrawals give you breathing room if coerced. And privacy? Tools like mixers are flagged as suspicious now thanks to regulations. One wrong click, and you're flagged. Zoom out. Crypto promises financial inclusion. 1.7 billion unbanked could access loans via a phone. But it amplifies inequality too. Whales control 90% of Bitcoin. Environmental costs linger, despite green mining pushes. Governments eye central bank digital currencies like the digital dollar piloted in 2025, potentially crowding out decentralized options. Is this freedom, or just another system to game? So for everyday folks like Alex or you, safe approaches boil down to this. Start with 1% of your portfolio. Diversify 50% Bitcoin, 30% Ethereum, 20% stables. Use regulated platforms, hardware wallets, and never click unsolicited links. Educate from verified sources, no Telegram gurus. And remember, it's not about getting rich quick, it's about control. But here's the lingering thought. In a world where banks can freeze accounts and inflation erodes savings, what if owning your keys isn't just an investment? It's insurance against a system that's already broken. Or is it?